Hello, everyone. I hope you're staying healthy and safe. My name is Katie Nozel, and I'm a senior studying finance and English in the AIM program, covering both domestic and international consumer staples. Today, I will be presenting and offering a recommendation of Conagra Brands Inc., ticker CAG. My research for Conagra was joined by my mentees, Quinn, McDaniel, and Elise Olwig. I would first like to touch on my screening process for finding this stock. With limited upside potential in the consumer staples space, CAG's business model was accelerated by COVID-19. I wanted to pitch a company with strong financials and initiatives in the post-pandemic world, and Conagra fits this criteria. Conagra Brands Inc. engages in the manufacture and sale of branded and unbranded processed and packaged foods. The company operates four distinct operating segments. First, grocery and snack, which accounted for 42% of fiscal year 20 revenue. The refrigerated and frozen segment, which accounted for 41% of revenue in fiscal year 20. Additionally, the food service segment, which accounted for 9% of revenue. And lastly, the international segment, which generated 8% of revenue in fiscal year 20. Conagra sells a wide range of products, including snack foods, plant-based protein alternatives, dessert mixes, frozen meals, condiments, butters, dressings, sauces, and lastly, canned goods, among other consumer staples products. On the right, you can see a photo of the various brands that Conagra has as its many subsidiaries. Moving on to my recommendation, Conagra Brands is the New York Stock Exchange's 11th largest food products company by market capitalization. And according to Barclays Research, from May 2017 to August 2020, the frozen service meals category accelerated retail sales by $575 million, and CAG was responsible for $545 million, or 95% of this growth. Through strategic acquisitions and divestitures, Conagra Brands has demonstrated an ability to successfully position its brands to maximize synergies, which has proven crucial to their business model. CAG has built brand empires that now dominate shelf space, ranging from iconic names such as Swiss Miss, Slim Jim, Healthy Choice, for example. Management's expertise in effectively identifying, integrating, and expanding 7 brands while divesting 7 brands simultaneously since fiscal year 16 has driven a net sales CAGR of over 5%. Conagra Brands most recently acquired Pinnacle Foods in 2018, a frozen and packaged foods company, for instance. Additionally, the company sold Gelit in 2018, which sells Italian-based frozen pasta. The company focuses on the sale of branded, privately branded, and value-added consumer foods, including frozen meals and snack foods, primarily serving grocery retailers while also delivering products to restaurants and other food service establishments. Continuing on, COVID-19 and its effects on at-home eating will prove fruitful for Conagra moving forward. Due to travel bans, stay-at-home orders, and work-from-home environments, consumers now desire time spent at home and convenient meals. Many consumers have invested in home updates, such as kitchen renovations, entertainment system installments, and work-from-home spaces over the course of quarantine, which suggests that consumers will remain at home longer term regardless of the pandemic's length to generate return for their various investments. Further, at-home eating will likely remain robust given the consumer behavior following the financial crisis of 2008. In 2012, 4 years after the stock market crashed and the recession that followed, at-home eating increased 200 bips. The 4 months following the emergence of COVID-19 has already triggered an at-home eating increase of 200 bips, which suggests that elevated at-home demand is projected to remain sticky in the post-pandemic world. As this trend continues, CAG products will remain a sustainable alternative for restaurant closings and consumers under financial distress. Moreover, Walmart Inc. remains CAG's largest customer, accounting for 24% and 26% of consolidated net sales in fiscal year 2019 and fiscal year 2020, respectively. Overall, with recurring cash flows from the consumer packaged goods industry and brand dominance of its various subsidiaries, it is recommended that Conagra brands be added to the AIM Small Cap Fund with a price target of $49.64, representing a 36.9% upside. Transitioning now to my investment thesis. Firstly, an innovation launch by Conagra Brands will drive the company forward. Financial deleveraging opportunities as a result of pandemic-driven incremental cash flows and reinvestment position Conagra to maintain a robust innovation pipeline. In Q1 fiscal year 2021, CAG repaid $135 million in debt, targeting a 3.5 times net debt to EBITDA by the end of Q3 fiscal year 2021, which will allow the company to further acquire and complete divestitures accordingly to refocus their portfolio. While CAG continues to pay down debt at a rapid pace, the company is gaining traction by expanding its on-trend brands across categories with efforts to co-brand products. By creating Healthy Choice Power Bowls, combining the efforts of subsidiaries Healthy Choice and Gardein, CAG ramped innovation initiatives representing 17% of sales, which will drive a net sales CAGR of 6% through fiscal year 2025 by accelerating co-branding. Not only has CAG demonstrated a proven track record of accretive acquisition and divestiture, M&A activity in the industry will progress and the innovation pipeline will remain intact. Secondly, the pinnacle of acquisitions. As of October 2018, Conagra acquired Pinnacle Foods in a cash and stock transaction valued at $10.9 billion, which has already resulted in the company improving its business operations, cost-cutting efforts, and expanding its breadth of reputable brands. However, $121 million of lingering synergies from this acquisition exist, as indicated by management. Upon full integration, CAG expects to see cost synergies of $305 million by fiscal year 2022. Pinnacle Foods contributed $46 million, or a 5% increase in international sales in fiscal year 2019, and will continue to expand CAG's global presence. By 2025, Pinnacle Foods will deliver higher gross profit margins of 30% compared to 28.5% in fiscal year 2018, driven by CAG's overarching value over volume strategy, an initiative intended to improve the profitability of its brands. And lastly, supply chain superiority. CAG introduced a supply chain productivity program aimed to create efficiencies across their supply chain given increased demand surrounding the COVID-19 pandemic and the approaching holiday season, which will elevate CAG's shipment capabilities. Conagra accelerated shipments to better track consumption, projecting a 7% year-over-year organic sales growth for quarter 2 fiscal year 2021, compared to the previous quarter where shipments far outpaced consumption. Additionally, as grocery shopping becomes an e-commerce driven process, this supply chain superiority will be highlighted by 60% operating margin expansion, considering that CAG holds strongly recognized consumer brands and focuses on consumer-centric product development. In terms of valuation for Conagra, in order to reach an intrinsic value for CAG, a 5-year DCF model was constructed. Using a terminal growth rate of 1% and a WACC of 6.5%, an intrinsic value of $57.06 was reached. A sensitivity analysis of plus or minus 50 bips on the terminal growth rate and WACC resulted in a 48.74 to 69.05 target range. Peer plays Tyson Foods Inc., Mondelez International, Hormel Foods, Campbell Soup Company, and the Hain Celestial Group were analyzed and used as peer play companies to determine the following relative valuation metrics. An EV to EBITDA multiple valuation was calculated using a 15.42 times weighted average, resulting in a price target of 50.26. Additionally, a PE multiple was conducted using a weighted average of 23.41 times, generating a price target of $40.22. By weighing the models 35, 35, 30, a price target of $49.64 was reached, resulting in a 36.9% upside, and Conagra pays a dividend yielding 3%. Similar to drivers, risk come along with Conagra as well. And three that I think are noteworthy are the smooth integration of potential future acquisitions, secondly, customer buying power, and lastly, sustainable packaging efforts. While management is very important for any company at stake, especially consumer staples holding companies, management does play a crucial role in the integration of various subsidiaries as well as the decision for various divestitures. So, leading Conagra's team, we have Sean Connolly as president and CEO since 2015. We have David Marburger, who is CFO and Executive Vice President since 2016. And lastly, we have Dave Beeger, who is an Executive Vice President and Chief Supply Chain Officer. These officers all have extensive experience in the industry, working at actually some of the pure plays for Conagra, which allows them to move the brands that Conagra holds forward and drive profitability. Thank you for listening to this part of the presentation. Quinn, Elise, and I look forward to answering everyone's questions both through the D2L discussion threads as well as on Teams at 11 a.m. on Friday, November 13th. Thank you for listening.